LGM Development Canada. I'm a chartered accountant by qualification, but I have been trader for a long time, about 20 years. I've been running currency trades and stock markets. I have all been focusing on equity and in some degree on debt as well. I am starting a program. It's a series of discussion as a common man financial view of the capital markets. So this series of discussion will be focused on various events that are happening in the economy of various countries, and the first discussion is essentially focused on Eurozone, because I have done some research and I have a clarity in my mind as to what has happened and what is the solution to this crisis, and I wanted to share my views with basically a common man investor who has put in his hard-earned money into the markets and has been not getting a candid opinion or this real situation on ground realities. On the Eurozone crisis, my view is that the new currency had strong fundamental when it get started. However, the people who were placed to monitor, particularly I would name a person who was responsible for all this crisis, in my opinion, is the ECB president, past president, Mr. Trichet, who was there from 2003 to 2011. His 8 years tenure, his leadership was weak. His decision-making skills were absolutely lacking. And I would substantiate each of the charges that I am making here. Reason is that from the very outset, the agreement that was in place to run the euro currency by all these states, that was never seriously taken, and he let it go and allowed the member states to not adhere to the particular covenant of debt limits. Secondly, the interest rates comparison to the US has always been euro had an edge, and currency were let to go in appreciation, which was not in the interest of Eurozone, in my opinion. And more specifically, if we compare 2008 onward, while these crises erupted and the US fund manager and the financial manager, particularly the Fed president and the Secretary of Treasury, they had been, I would say, at the outset were very active and brave to take action, particularly on the interest rate, and brought it down to a level and also injecting stimulus to the economy. As a result, what we see now, after a span of over 2.5 years, the American economy has started improving. There are signs, clear signs of recovery that we see. On the other hand, the European ECB was not reducing the interest rate where they should have been. In comparison to the US, it should have also been brought down to 0.25, so that the currency has a certain comparison to the US at a level of say $1.20 to a euro, and the president ECB and its members let it appreciate the currency to a stage. As a result, now that they are really feeling the pinch, and even the existence of euro is being talked about, whether they can really hold it. And all this has happened in the last 3 years, because if they would have taken those actions at that point in time, then they would have not been in this stage. It's very clear that Greece has to call for an exit, because they cannot print currency, and their debt to GDP ratio is so high that they are unable to raise additional debt to pay off a regular money that they need. So is Italy, and so will be Spain. But I would be concerned even with the French, because the cost of funding, cost of debt, even in their case, would also be high, gradually will go up, and which will have also impact in Germany. But all efforts are focused to keep the currency intact, which is a very wise thing to do, because the cost of leaving euro and restarting their own currencies would be so phenomenal that every company has to then rewrite all their agreements, and they have to translate into local currency, and most of the company will go bust, which is not in the interest in the global economy and for the eurozone. Having said that, it's very clear that euro will stay weak. It would come down even below 1.20 level, in my opinion, and that is going to stay for a considerable amount of time, if at all it stays back. So there is a clarity as far as the euro is concerned, as how the direction would be to the eurozone, and they will take 2 to 3 years to start recovery and fight recession at this point. Now a question that was asked about a week ago to 15 billionaires as to if they have $1 million where they would like to invest, and this question has been answered by them in very vague terms. Because the thing is that a billionaire is very wise because they have made money, so everybody would tend to ask these questions to them. As a common man, I would say that if I have a 1 million where I would like to invest at this point, realizing what the capital markets are and how the currency market is doing and how the debt market is doing, I would say 40% I would invest in the currency market, 40% I will invest into equities, particularly focusing with the oil and gas stocks, because that is where the volatility is, and 20% I'll keep cash in order to reinvest at the time of appropriate moment when the opportunity comes. But currency market, because that is giving maximum return. Reason is that the volatility is the name of the game, and you can see here that even in one night you can see in 24 hours about 3% up and down. Currency can go up and down depending on how the news are coming from the region or globally or wherever it is. So the size of trade that is happening internationally on the currency market is in the range of about 3 trillion every day, whereas the stock markets are in the range of about 700 to 800 billion dollars. And besides, you need a large capital to invest into the stocks. A good stock with a $50, say, a price of a share, you need lot of money to invest. Therefore, currency markets still provide a great opportunity if you really play well and see how things are happening. And with this discussion, I'm not contemplating to direct anybody or give an idea or suggestion where to invest, but I'm specifically into any particular item. But my view is, to a general investor, that this is how you should be investing your money in currencies or stocks. And the currencies, particularly what I am doing is I am very clear about euro, that I will short euro because I'm very clear it will go to 1.20 level or even below, but that is what I see. Similarly, Australian, New Zealand currencies will get some bashing because of the slowdown that is foreseen in China. Therefore, that is also an opportunity coming. On the other hand, the Japanese yen is where it is, at 70. It cannot stay at this level for a long time. It has to cross 80 yen mark to a dollar or upward, but it can't be below 75, in my opinion, at any stage of time, because if that happens, the government of Japan is going to intervene. Because that is not in their interest to keep that currency at that level. Therefore, if we have, this convinced on this level, then it is easy to short Japanese and go long compared to Canadian dollar or, for that matter, US dollar. So this is how I would distribute my asset of $1 million into currency and equity and cash. For the time being, this is how my first discussion on this subject is, and I will be doing this on a weekly basis, and I'll come more specifically on the item where to go in investment ideas, provided you like my ideas, and if I get some feedback from. Thank you.